Welcome back to Investing Talk Podcast.
Good to be back.
We are zeroing in today on a really crucial company in the tech world, Kulicke and Soffa Industries.
Right, KLIC.
And the core question, as always, is simple. Is this semiconductor equipment manufacturer, a good time to buy right now?
That's the million-dollar question.
Before we jump into the sources, just a quick reminder, please hit that subscribe button, give us a like, and definitely leave a comment below.
Yeah, we really do want to hear your thoughts.
And hey, if there's a specific company you want us to analyze in the future, drop that name in the comments too. We'll add it to the list.
Absolutely.
Okay, so our mission today is pretty straightforward. We're going to pull out the key insights from, all the source material we could find covering the fundamentals, the technicals, the catalysts.
And try to give you a complete picture fast.
Exactly. So let's unpack this and set the stage. What exactly does Kulicke and Soffa Industries do, and why are they so, foundational to tech?
Right. So KLIC, they design and make the capital equipment for semiconductor assembly.
Okay, so not the chips themselves.
No. They build the really specialized complex machines that connect, package, and protect those tiny silicon bits. They make it possible to actually put them into devices.
So they're enabling the actual manufacturing.
Precisely. A critical enabler for high-volume manufacturing.
Yeah.
And that means they're plugged right into these huge growth trends.
Like what?
Well, think advanced packaging, stacking chips, connecting them in super complex ways. That's vital for AI, for autonomous driving, 5G, IoT, all that stuff.
And KLIC's machines make that happen.
Their equipment makes it possible, yeah.
Okay. That leads right into their competitive advantage, their moat. It sounds like a specialized field, but what really gives them pricing power? What stops others from just copying them?
It boils down to really deep proprietary expertise in bonding technologies.
Bonding?
Yeah, connecting things at the micro level. They do it all: ball bonding, wedge bonding, even stuff like advanced display and die attach. But here's the really fascinating part, the thing you absolutely need to know. There's a specific technology where they have a massive edge. Our sources say KLIC is the only qualified supplier of something called fluxless thermocompression bonding TCB for high-volume manufacturing.
Hold on. The only qualified supplier?
That's what the material indicates, for high volume.
That's not just a small advantage. That sounds like a huge technological barrier. If they own high-volume TCB, which is critical for, stacking DRAM for AI.
Exactly. That implies some serious leverage down the road, doesn't it?
Yeah, you'd think so. In contract negotiations, I mean.
Precisely. That TCB exclusivity, that's really what underpins the whole long-term bullish case. It suggests they could capture a really big slice of the pie when advanced packaging truly takes off.
Okay, we need to keep that moat in mind then, especially that TCB detail as we look at the financials. Because the recent numbers, they don't exactly scream dominant player.
No, they don't. Let's shift there. The recent data shows they've been through a pretty rough patch.
So the TTM data trailing 12 months, what does that tell us?
All right, TTM, last 4 reported quarters, smooth things out a bit. Looking at those figures, you definitely see the impact of the recent sector downturn and some strategic pain we'll get into.
Okay, the numbers.
Revenue came in at $657.8 million, which is, okay. But the TTM net income was really squeezed, just $5.95 million.
Hey, $5.95 million for the whole year.
Over the last 12 months reported, yeah.
Okay, that's why the trailing PE ratio looks insane. Sources put it at 373.23.
Exactly. Astronomical.
So if earnings are that low, how on earth do analysts have a strong buy rating on this thing? That PE paradox is pretty jarring.
It really is, and it's basically the definition of a stock at a potential turning point. The market seems to be looking right past those TTM numbers.
Ignoring them. Why?
Well, those numbers were hit hard by the semiconductor cycle slump and by a huge internal restructuring charge we need to discuss. So analysts are betting everything on a really sharp recovery.
Ah, okay. And that's reflected in the forward PE.
Exactly. The forward PE is way down at 37.59. Much more reasonable.
37. Okay, that sounds more like it for a growth area. So what's the market actually expecting to happen?
They're expecting massive earnings growth in the next year. They think the restructuring pain is over, and those new high-growth product lines will start kicking in revenue.
And the consensus reflects that.
Yep. Strong buy. The average 12-month price target is around $48.33. That's about, 17.7% upside from where it is now.
Okay. What about tip ranks? Any different?
Similar optimism. Their average target is a bit lower, $40.50, but still positive. And hey, don't forget the shareholder signal here, too.
A dividend.
Yeah, they kept paying the annual dividend. And 70.82 cents. Yields about 2%. even through this rough patch.
Okay, but let's circle back. You mentioned the consensus is all about forward projections, right? Believing management's promises of recovery.
Pretty much, yeah.
Doesn't that require a really solid financial foundation? Like, what do we know about their actual balance sheet health? Debt, liquidity, cash flow.
Here's where we need to be really careful. This is a major point of caution in the source material we looked at. Unfortunately, specific financial health metrics, stuff like net debt, detailed liquidity ratios, audited free cash flow figures, detailed margins from the very latest 10K or 10Q. Well, we couldn't verify them from the available data.
Wait a second. Are you serious? So investors are slapping a strong buy on this based on that TCB thing and a hoped-for recovery. But the actual measurable proof they can survive the storm, the cash flow, the debt load that's missing from the recent materials.
It wasn't clearly available in the sources we reviewed for this analysis, no.
How comfortable should anyone be with that? That feels like a big leap of faith.
It definitely introduces execution risk. Look, KLIC is generally seen as financially stable, historically, but relying on, let's say, implied health instead of verified numbers from the latest reports, that's risky.
So we have to caution listeners here.
Absolutely. The foundation for this bullish view right now seems based more on market sentiment, sector recovery hopes, and that TCB moat, not fully transparent, recently confirmed fundamental health.
Which makes the upcoming earnings report even more critical.
It's ghastly. November 8th is huge for them. They need to deliver clarity.
Okay, that makes sense. So let's look at what management has been doing. What actions have they taken in the last, say, 3 months to get ready for this growth cycle? Let's start with the pain points.
Right. Well, the biggest move was winding down their electronics assembly business, the EA division.
What did that division do?
It basically provided equipment for more, let's say, conventional electronics assembly, outside their core semiconductor packaging focus. Management cut it to streamline, focus entirely on high-growth stuff like advanced packaging.
And I bet that cut wasn't cheap.
Not at all. Extremely expensive. That's what caused the cautious sentiment, the sequential revenue dip we saw. It triggered massive restructuring charges and asset impairments. Over $80 million.
$80 million?
Yeah. Just think about that compared to the TTM net income of under $6 million we just talked about.
Wow. 13 times net income.
Okay. So they took a huge financial hit intentionally to reset the company's focus.
Right. That paints a much clearer picture of why TTM earnings were so awful. It was a deliberate, deep cut. So what are they focusing on now? What are these new products justifying that big recovery hope?
They're launching tools for really specialized high-margin areas. Back in August, they launched the AT Premier MEM Plus.
Okay. What's that?
It's a new wafer-level packaging tool specifically designed for stacked DRAM. Think high-end AI servers. That's a hot market.
Definitely. Anything else?
Yeah. They're also beefing up their presence in power semiconductors. Critical stuff for EVs, industrial efficiency. They've got new products coming there that should drive revenue starting in 2026.
So the theme is moving away from general assembly.
And doubling down where their special tech like TCB gives them the biggest advantage.
Exactly. And are we seeing any signs from customers that the turnaround is starting? Any demand signals?
We are, actually. Towards the end of summer, utilization rates reportedly improved in China and Taiwan.
And higher utilization means?
It signals customers are getting busier, preparing for more capacity investment, which usually means new orders for equipment makers like KLIC aren't far behind.
That's positive.
And adding to that confidence, management bought back over 500,000 shares in August. So about $21.3 million. That signals internal belief, even with that big restructuring hit.
Okay, so it all seems to hinge on this next earnings report. The big near-term catalyst is definitely the Q3 2025 release on November 8th. What should listeners be watching for?
Two main things, I'd say. First, confirmation the restructuring pain is truly over. They need to show stabilization after that EA closure, prove the $80 million hit is done.
Right, put it behind them.
And second, they absolutely must show momentum in those new high-growth lines. People will be listening hard to the guidance commentary on AT Premier MEM Plus and power semis. Does the 2026 recovery story still hold up?
Got it. And beyond the official earnings, what about speculative buzz? Any rumors that could move the stock?
Oh, there's always chatter in this sector. A few things float around. One is about potentially large capacity orders coming out of Asia, specifically using that new AT Premier MEM Plus platform.
Oh, okay, that would be big.
There's also some buzz about a possible strategic partnership, maybe supplying advanced packaging tools for new AI hardware players. And, the usual M&A talk, maybe KLIC acquiring some small specialized equipment startup.
Right. Always a possibility. Okay, let's shift to the technicals. If the fundamentals point towards a bullish future, maybe, how's the chart looking right now? Key levels to watch.
Well, the current price is around $41.61, comfortably inside its 52-week range, which was about $26.63 up to $52.08.
And the recent action.
Technically, it actually looks pretty healthy right now. It had a nice bounce near the $40 level, which is good psychological support. And it's trading above both its 50-day moving average, around $37.71, and the 200-day, around $37.50.
So solid medium-term support there.
Seems like it, yeah.
Okay, so the floor looks decent. What about the ceiling? Where's the immediate resistance it needs to break before November 8th?
The key level seems to be right around $41 to $42. Getting through there and staying above it, that's really essential to confirm a positive trend reversal.
And if it does break through?
Well, Stock Invest data we saw suggests it could potentially see maybe an 11.8% rise over the next 3 months, capturing some of that pre-earnings excitement, perhaps.
What about momentum? Are the indicators confirming this strength?
They're a little mixed, actually. Suggests some balance, maybe caution is needed. The RSI, Relative Strength Index, is at 43.48.
Which means?
Which is good. It's not overbought. Plenty of room to run if a bullish catalyst hits. But the MCD indicator is still technically on a sell signal.
Ah, so maybe some choppiness?
Could be. Or consolidation.
Yeah.
Until we get maybe more official confirmation of trend reversal, probably tied to that November 8th news.
Okay. And finally, before we put it all together, the risks. This is a cyclical sector, right?
Absolutely. Risk number one is always sector cyclicality. If global semiconductor capital spending slows down again, if this recovery stalls, KLIC gets hit immediately.
Makes sense. What else?
Management themselves mentioned ongoing trade uncertainties, tariff volatility in Southeast Asia.
Yep.
That's an external headwind they're watching.
Okay.
And finally, circling back to what we discussed earlier, that company-specific risk is execution.
Right. Can they deliver?
Exactly. The whole bullish case relies on that restructuring paying off quickly, the new products gaining traction like they hope, and that earnings recovery actually happening. It's priced in, but it's not guaranteed until they execute.
Okay. So pulling it all together now, what does this mean for you, the listener? We've got the deep tech moat, the painful but possibly smart restructuring, these bullish forward projections. How do we sum it up?
Well, the source material we analyzed leans towards an overall bullish rating. Pretty strong, actually, like an 8 out of 10.
An 8 out of 10. Okay.
Yeah, Kulicke. And Soffa is seen as this crucial enabler in a growth area, advanced packaging, the recent low earnings, viewed mostly as temporary pain from that necessary big restructuring. The consensus clearly expects a major rebound.
But the investment horizon seems really important here. How should people think about that?
Definitely. Short term. It looks attractive, mainly for technical traders, focusing on that November earnings catalyst, especially if it breaks and holds above that $42 resistance.
And
Sort of the long-term investor focused on secular growth. KLIC seems really well positioned, benefiting from the whole advanced packaging boom driven by AI. Plus, you've got that TCB tech moat, and they pay a dividend.
So the key takeaway seems to be that Kulicke and Soffa is at this major inflection point. They did some aggressive self-surgery with the restructuring. They're investing heavily in new tech.
And now they seem poised for renewed growth through 2026, really targeting those high-margin, high-growth semiconductor segments.
Okay.
And that brings us back to maybe one final thought, something provocative for you to chew on as you watch this unfold into November. If we accept that premise that KLIC truly is the only qualified supplier of high-volume fluxless thermocompression bonding, what could that mean for their pricing power and ultimately their operating margins, say, in late 2026, 2027?
Yeah.
Assuming the semiconductor recovery holds, of course.
That technological scarcity.
That's potentially the most compelling long-term angle here, something to really consider as you watch that November earnings report.
That is a fascinating point to think about. All right, thank you for joining us for this look at Kulicke and Soffa Industries.
My pleasure.
We hope this gave you the key insights you need to evaluate the company. Don't forget to subscribe, like, and comment. Let us know if there's another company you want us to examine next time.
Until next time, keep investing smart.